for us, our competitive advantage is our people and culture. And, hopefully we've tried to build a culture, and we've had the opportunity to build a firm. Our firm's only 15 years old, to kind of build it in a new world where collaboration really matters.
We have a graphic we're going to put up briefly that should be helpful in understanding the immense scope of private credit. And you see all of these categories. They're endless, practically: railcar infrastructure, agricultural lending, movie lending, inventory financings. It goes on and on. We don't have to get into all the categories, but just to give you an impression of how big this is. So the question I have for you guys is, we'll start with Josh. How did this enormous, not a pond, it's an ocean, be mistaken for a pond and fly below the radar for so long?
Well, first of all, thank you for having me here, and I couldn't be more excited to have share a stage with Apollo. Look, this was the intended consequence, not the unintended consequence, of the regulation that came out of the global financial crisis, which was policymakers woke up one day and there was a $700 billion put that they wrote for the global financial system, or U.S. banks, and they wanted to figure out how to diffuse risk away from the taxpayer and away from the FDIC. And so you couldn't crush the economy by reducing credit, and so the private credit industry grew. The private credit industry actually has, I think, a better model, a more robust model, holds more capital for the loans that they have on their balance sheet, has better funding, match funding. So it's a more robust model with less risk without a taxpayer put. So I think this was the intended consequence.
Yeah, but it's been mistaken for the high yield market, leveraged loans. Can we go through that?
Sure, and first I want to thank you. It's been a while since anyone referred to me as young, so thank you. But I think what Josh said was correct. I think there's a supply and a demand element, and maybe we'll get into the demand for some of the assets that you had up on the screen. But as the screen showed, a number of people think about private credit as financing maybe middle market loans, and that is a portion of the market, but as that slide showed, it's a very small portion of the market. And at Apollo, a large portion of what we do, which I think surprised a lot of people, is actually investment grade risk. So when you looked at a lot of those categories, those assets generate investment grade funding for us, or that we provide to those originators, and very attractive assets for our insurance balance sheet, as well as our funds. So I think there's just this misnomer that private credit is a high yield or leveraged finance market, which a portion of it is, but the large majority of what you had up on the screen actually is investment grade risk, and a lot of that, as Josh was saying, drives economic growth and prosperity. So we're lending to not just small companies, but large companies as well.
Yeah, and how did the problems with the regional banks and the smaller banks that we've seen since the SVB collapse, how has that affected your growth or the migration of assets to the alternative managers, which had, of course, this trend started way before that in the great financial crisis. Was it accelerated with these issues that the banks have had with capital essentially fleeing?
My view of it is that it really showed the robustness of the business model, which was banks' business models are they lend long and borrow short. And what kills financial institutions tend not to be an asset quality issue, but tends to be a liability quality issue. And so banks have weak liabilities in the sense that you can go and take out your dollars anytime you want. And so I think it showed the value of our business model, both from what we do for the economy, but what we do for investors, because we don't have that asset liability mismatch, and allows us to be a really good, stable counterparty for the issuer on the other side, which is we get to keep on supporting that company or supporting that asset class or supporting that originator, and our capital is more durable. So I think that was a watershed moment for the value of the asset class, both for the investor and for the end user of capital.
And the one thing I would add, again, think about like the assets that created some of the problems last year. They were, HQLA, they were treasuries and, mortgages. They just had long duration. And to Josh's point, you just have this mismatch where you're funding long-dated assets or illiquid assets with short-term liabilities. We don't run a business that way. We're much more match funded. But I think the other misnomer about, again, leverage finance versus investment grade assets is we're not looking to disintermediate the bank. In fact, if anything, it's the opposite. Like Mark Rowan will say, we don't want the bank's client, we want the asset. And I think the banks or the entities that are smart and forward thinking realize our balance sheets are a virtual extension of their balance sheet. They can use our balance sheet, which those assets have a more natural home, and still kind of do all the other things of cross-selling that they want to do and own the client, but let us own the asset on our balance sheets.
Right. So are the banks working more, I think you guys would put it, in the moving business, not the storage business? They're getting fees, they're doing originations, but then you're parking the assets with you. Is that pretty much what's happening?
I think that's part of it. I think the banks, the regulatory regime of banks is the regulators want banks to not have, the risk-weighting asset system wants them to be wholesale financing sources for the private credit industry. That is actually what they want them to do. And so, they already have hundreds of billions of dollars out to the private credit industry in wholesale financing. And I think what they really want them to do is provide other services that are capital light services to the clients. So if it's, liquidity management, checking, 401k, all those types of services that we're not in the business of servicing, but they really want the assets to be in a different place.
Yeah.
And I want to just go back also because you asked, I think this is still the early innings of this game playing out. Because again, if you think about it, if you're a bank and you're kind of looking at your asset liability match, you probably, if you went back 5 or 10 years, you're like, okay, I have this deposit and it's going to be here for a long time, so I'm comfortable buying this long dated or illiquid asset. I think what we've all realized with just the speed of what happened last year is all of us can literally, before this panel's over, withdraw our money from the bank. And it just forces the banks to kind of get out of the business of holding either very long dated or illiquid assets because they don't have the liability structure that our firms have.
Right. It's always amazed me too that you're competing with the bond market too, the publicly traded bonds, because the definition of private credit is it's not publicly traded, even though it's a gigantic asset class. But what I've always found amazing is you're able to get higher yields on the same duration, in other words, the length of maturity, and the same credit quality through the rating agencies, the same ratings on these bonds as the public markets, but you get an extra 100 or 200 basis points in yield. Can you explain how you're able to derive those premiums?
I think it's value. It's not only perceived value, but it's value to the issuer, which is banks are in the moving business, which when they talk to an issuer, they say, hey, we don't know where your bonds are going to price. We'll underwrite them. We'll either do it on a best efforts basis or we'll do it with caps. And so your range of outcomes is X plus Y. The private credit industry basically says we will own that risk at X. That X is going to be wider than the tights, but probably inside the caps. And so that extra economics plus the origination fee gets economically picked up to the issue, to the investor or the private credit provider, but there's real value of certainty being provided to the issuer. There's also less friction. There's, you know who, it's not going to be held in the markets. You know who your lender is. You are dealing with one counterparty. You don't have to go through a ratings process. And so it's all about value to the end user, and that value is just not captured in a single number of spread number. It's captured through the process. It's captured through certainty. It's captured through ease of use.
I think I would just echo the size, speed, and certainty. Like private credit is not going to eliminate like public markets. It's actually a complement to them. And there are, some assets, if a triple B or a single A company needs to borrow money, they're just going to go to the investment grade market and blow that, issue through the pipe. There are times that markets, start to seize up a little bit, as we saw in 22 and 23, and you may see some activity that maybe in a more benign environment would end up in public markets, end up in private markets. But I view it as a complement to public markets. And again, even if you went back in time, like you think about the evolution of the investment grade market, high yield market, the tradable loan market, I think the private credit market is just that next, evolution of assets and activity migrating out of the banking system into the, public, if you will, hands.
Yeah, also, I know that both of you have specialized teams, that many of which came out of the banks that specialize in rail car financing, airplane financing, leverage loans, numerous categories. And you got these teams on the ground finding the best deals. And the banks have lost those teams, GE Credit, many other organizations. Can you go through, Josh, the advantage that you have or the edge that you have with these specialized teams that you have in-house?
Well, I think the bigger, look, for us, our competitive advantage is our people and culture. And, hopefully we've tried to build a culture, and we've had the opportunity to build a firm. Our firm's only 15 years old, to kind of build it in a new world where collaboration really matters. And so we have that 3.0 version of the alternative asset management firm. But the real issue is not only is capital changing and the regulatory framework for banks, but that's led to, I think, a little bit of a brain drain from DNA from banks. I started my career, or middle part of my career, was at Goldman Sachs. Before that, I was at Wells Fargo. Carrie was at Citi for a long time. And there's this flow of talent, not only senior talent, but junior talent, away from banks and into our system. And that's ultimately what makes a difference, that in culture.
Yeah, and I would add, in addition to people and culture, we think two of the things that differentiate us is, one, the Athene insurance balance sheet, which has structural liquidity. It's raising 7 and 10-year liabilities, which allows us to take illiquidity or structure risk because we don't need daily liquidity, maybe like a mutual fund does, and we capture that incremental 100 or 200 basis points. The other would be our origination platforms, that we can create the alpha ourselves, and whether it's then those assets end up on the insurance balance sheet, in the funds, some of those assets end up in the market. But being able to leverage off of the 16 origination platforms, we think is differentiating alongside having Athene's balance sheet and the structural liquidity that comes with it.
Yeah, and it's fascinating to me that you guys both left major jobs at major banks. How did you see this thing coming so early? Because you immediately went into this business with, you're going to Apollo.
Well,
Josh, yeah.
I saw it of necessity, to be honest.
Yeah.
I mean, I was sitting inside a business that ultimately survived in Goldman Sachs, but there was a vocal rule, and I remember I was sitting with my bosses, a guy named Harvey Schwartz, who now runs Carlyle, and he says to me, "Hey, Josh, do you think the Fed's going to want Goldman in your business?" In 2000, this was in 2009, and I'm like, I think I need to go find another job. So yeah. Mine was out of, a little bit about necessity, and I kind of joke around. I said, Sixth Street wouldn't have been born if it wasn't for, I was 32 years old and too dumb to think it was going to be hard, and the global financial crisis. Gary?
Look, we were joking with, before this, like, Josh was a founder, like, I jumped on the bandwagon. I'm a slow learner, but, I obviously knew Apollo and similar firms because they were, great partners and clients of the firm, but, it was clear how hard it was to get things done that made economic sense in the bank environment versus, I think both of our firms are probably more commercial in how we make decisions and how we price risk.
Okay, guys, thank you so much.
Thank
Terrific,
you.
great job.